So, Professor, I think that there's one underlying question that I think all of us really need to understand. And I think that Milton Friedman kind of summed up your points 2 through 10, where he says that profits encourage risk, loss encourages prudence. And your points 2 through 10 outside of monetary policy suggest that countries violated that, whether that's European countries violating the Maastricht rule, 3% of their GDP to be deficit, 60% for total debt, or companies where we saw bailouts and stimulus. So my question is, how perhaps do we allow these companies that are too big to fail, so that loss can encourage prudence?
Yeah, it's a real good question. And you'd be quite right, when you bail out a country like Greece, you're encouraging that kind of behavior by governments. We used to be bailing out emerging market countries like Argentina and Russia, Mexico. That was in the 90s. That stopped, and actually after it stopped, their performance got better because that failure problem went away. But now we have the problem with financial institutions, too big to fail. And I think it is a very serious problem. How do we deal with it? I think the best way is to find an alternative to the bailout. Find another way to deal with the situation when a large financial firm gets in trouble. So I mentioned how terrible all the bailouts were in 2008. So one way to deal with it is to change the bankruptcy code. If a firm here in the Valley gets into trouble, it files Chapter 11 or maybe Chapter 7 ultimately. Chapter 11, United Airlines files Chapter 11, the planes keep flying. Kmart files Chapter 11, you still go buy stuff in the store. Business keeps going. The same thing could happen in principle to financial institutions. You get in trouble, they keep issuing checks, they keep giving financial services. So there's actually work underway, we're doing it at the Hoover Institution, to find a new chapter for the bankruptcy code. We're calling it Chapter 11F for financial institutions. And so then a financial institution, even a big one, when it gets into trouble, could go in a very orderly way into this Chapter 11F, keep continuing to do its business, providing service to its customers, reorganizing, and then you don't have the government bailing out. So that's an example of this alternative, which I think you need to have. Otherwise, there's always going to be this great pressure on government officials to bail out and perpetuate the too big to fail problem.
Professor Bob, the paper.
Hi, Professor. I'm curious, is it true, I've heard that the Federal Reserve is paying a higher interest rate to banks to park their money with them than the banks can get from consumers and business loans and that kind of thing. So, of course, then the banks aren't loaning out the money.
Yeah, so the Federal Reserve is offering an interest rate to the banks that lend money to the Fed, as you say, park money at the Fed. It's a quarter of a percentage point at this point. So the banks, in turn, can have this alternative to make loans to businesses, which is at a higher interest rate, and they're not doing it at this point. So what's the solution? Well, some people say we should lower the interest rate that the Fed pays so that there's a more advantage to lend to a business or to a consumer than to the Fed. But the truth is, it's just 0.25%, 25 basis points. So if it would go to zero, I don't think, quite frankly, it would make that much difference. You still have this problem that because the economy is slow, businesses are not doing well, that the loans are down. So it is definitely an unusual situation. Actually, I think it would be better if they raised the interest rate, say to 1 percentage point. And then there would be an incentive for the banks to loan each other money, and you could get money in the sectors of the economy where it's more needed. Now, because that interest rate is so low, there's not much lending and borrowing amongst the banks, and that means some banks are holding a bunch, other banks don't have much, and those banks that don't have much, they're frequently the ones that could be making the loans to small businesses.
Thank you. Next we have Mike Bolina, a young man who has a question for you.
Well, I'm going to try to phrase the question, make it easy, but it's not that clear to me, so bear with me. I've done some reading on the history of money, and it looks to me that money is a tool provided to people in order for them to be able to exchange goods and services, because it's very difficult to do barter on everything. So I have a problem when I'm thinking about money, and I don't really know what they mean anymore, because it's no longer a matter of that is determined between the buyer and the seller, but it's the money itself, the currency these days, is no longer an absolute. It's not something you can say it means this or it means that. There's some group of people somewhere determined based on whatever, what it means. So instead of talking about the policy, I'm more interested if you can comment on what is money and what can we do to restore the meaning of the money and the absolute value.
So money is, the easiest part of money is the currency that we take around in our purse or our wallets or our pockets. That's money. It gets more difficult to understand when you realize that money is also electronic, that you can shift money around between one firm or another, one bank or another, just by moving accounts from one account to another. So bank accounts are also a form of money. Or when we talk about these swaps from the Fed to the European Central Bank, that's yet another form of money. Or when the banks are parking money at the Fed, that's also money. So the easiest thing is the currency, but very similar as all these other things. So to define it, you define it as whatever is used as a medium of exchange to make payments and sales. Easiest to see with the currency itself, but it's also very similar with the electronic form. One thing that it's, if I might just share a little story about money with you, one of the things I had to do when I was Undersecretary of the Treasury was to help set up a new financial system in Iraq. In Iraq, in some countries, it's almost all currency. It's all paper stuff. Their money, it's easy to understand, it's all paper. But it's also kind of confusing because, say with Saddam, he just printed his currency, we call it the Saddam dinar, only had 2 denominations. It would be like, all we had was nickels and $5 bills. That's what he did to his people. So we had to find another way to deal with this, so we helped the Iraqis create a new currency, helped them print it. It was quite a problem with me because we had to do it quickly. It's a security problem. So we had to estimate how much money they needed. Fortunately, there wasn't much electronic stuff. It was all just paper. So we estimated it would require 27 plane loads, 27 747 plane loads, 27 747 plane loads of currency with 6 denominations now to get into Iraq to get to so that people could exchange their old Saddam dinars. And it really worked. It didn't create inflation, and people were happy with their new currency. So it's a long way to answer your question. So defining these days the currency meant simply estimating how much you need in this country.
What I meant to say is that, you know, when we talk about the kilogram or the meter, these are standards. Somewhere in France there is a room where they keep all this measuring, you know, they keep all these units, and it means something. If the meter, the standard of meter would always change, then we can no longer have a meaningful conversation about building things, or we can say what...
Yeah, like I said, that's why you want to not have inflation. You want to keep prices steady, and then you have a stable unit to compare goods and services.
Next we have Scott Kirkland.
Hi, Professor. I'm curious, when in your mind is a business or industry too big to fail? I heard a lot of counterpoints when we were doing bailouts. It's like, well, we should have just let GM fail, we should have let the banks fail, taken our licks, and then recovered at that point. How bad would it have gotten if we just let the banks fail?
Well, one of the problems with too big to fail notion, sometimes it's called systemic risk, is that it is not well defined. That's exactly why your question is so important, and no one can define. The bill that's in the Congress, the Christoph bill, uses the word systemic risk and too big to fail all through it, but there's never a definition. So, I mean, it's kind of crazy, but there's no definition. So actually, I recommend that at least you got to define it. And to me, defining it means looking at the size of the institution and how interconnected it is with other financial institutions. But I would ultimately like to have a system where even a highly connected large institution was not